The truth about prop firm trading. Why 99% of traders fail the challenge and who's really making money. In 2023, a 24-year-old trader named Jake posted a screenshot on Twitter showing his prop firm payout, $47,000 for 1 month of trading, and the tweet went viral, got hundreds of thousands of views, thousands of retweets, and the comments were full of people asking which prop firm he used, how he passed the challenge, whether prop trading was really the path to financial freedom that YouTube and TikTok influencers were claiming it was. Jake's success story, along with hundreds of similar posts flooding social media, created a narrative that prop firm trading was the great democratizer of finance, that you didn't need $100,000 of your own capital to become a professional trader. You could just pay $300 to $500 for a prop firm challenge, pass a couple of trading tests, and boom, you'd have access to $100,000 or even $200,000 in trading capital and could keep 80 to 90% of the profits you made. It seemed too good to be true, and that's because it was too good to be true, because what Jake and the other successful traders posting their payouts weren't telling you, what the prop firms definitely weren't advertising, was that for every one Jake making $47,000, there were literally thousands of traders who paid for challenges and failed, lost their $300 to $500 entry fee, and never saw a cent in payouts. The pass rate for most prop firm challenges is somewhere between 3 to 10%, meaning 90 to 97% of people who pay for these challenges fail and lose their money. And when you do the math, when you calculate that a prop firm might have 10,000 people paying for $100 each for challenges, that's $4 million in revenue. And if only 300 of those people pass and get funded accounts, and maybe 30 of those actually make consistent profits and get payouts, you realize very quickly who's making the real money in this system. And it's not the traders, it's the prop firms themselves who have created a brilliant business model where they get paid upfront regardless of whether traders succeed, and where the vast majority of their revenue comes not from trading profits but from challenge fees from failed traders. Let me explain how prop firm trading actually works, because the marketing makes it sound simple and the reality is much more complex and frankly predatory. A proprietary trading firm, or prop firm, is supposed to be a company that uses its own capital to trade financial markets and hires traders to trade that capital, splitting the profits, and this model has existed in traditional finance for decades. Firms like Jane Street and Citadel Securities are prop trading firms that hire elite traders from top universities, pay them salaries plus bonuses, and give them access to millions or billions in capital. But the prop firms marketing to retail traders, the ones advertising on YouTube and TikTok and Instagram, these are not traditional prop firms. They're something different, something newer, and they operate on a fundamentally different model that's much more favorable to the firm and much less favorable to the trader. Here's how it works. You pay a fee, typically $150 to $600 depending on the account size you want, to enter what's called an evaluation or challenge. During this challenge, which usually has 2 phases, you need to hit certain profit targets, usually 8 to 10% in phase 1 and 5% in phase 2, while staying within strict risk management rules: maximum daily loss of 5%, maximum total loss of 10%, no holding trades over weekends in some cases, no trading news events, various other rules that are designed to be difficult to follow perfectly. And if you hit the profit targets while following all the rules, you pass and get a funded account, which means you can now trade what the firm claims is real capital, usually the same size as your challenge account: $25,000, $50,000, $100,000, $200,000, and you keep 80 to 90% of any profits you make. Sounds great, right? But here's where it gets tricky, and where most people don't understand what's actually happening. First, passing the challenge is genuinely difficult. The profit targets are achievable, but the risk management rules mean you have very little room for error. 1 or 2 bad trades and you've hit your daily loss limit or max drawdown and you've failed. You lose your $400 and have to start over if you want to try again. And the statistics show that most people fail. Some estimates put the pass rate at around 5%, meaning 95 out of 100 people who pay for a challenge lose their money. And the prop firms know this. Their entire business model depends on it. If 50% of people passed, they couldn't afford to fund that many accounts. They need the failure. Rate to be high for the economics to work. Second, even if you pass the challenge and get a funded account, you're not necessarily trading real money, or at least not in the way you think. Many prop firms, particularly the newer ones targeting retail traders, don't actually place your trades in the real market. They're operating what's essentially a simulator. You're trading against the firm, they're taking the other side of your trades, so when you lose money, they keep it, and when you make money, they pay you out of their own pocket, which means they're directly incentivized for you to lose. They make more money when their funded traders blow up than when they succeed, and while some firms claim they hedge their exposure, that they're taking your best trades and placing them in the real market, there's no transparency, you have no way to verify this, and the incentives suggest that most don't bother. Third, even if you pass and get funded and start making money, the withdrawal process is often difficult and slow. Traders report waiting weeks or months for payouts, having withdrawal requests denied for minor rule violations they weren't aware of, or being told they need to trade for a certain number of days before they can withdraw. And some firms have been accused of retroactively disqualifying traders who make too much money too quickly, finding obscure rule violations to justify not paying out. And while not all firms do this, the lack of regulation in this industry means that firms can pretty much make up rules as they go, and traders have very little recourse if they feel they've been treated unfairly. You can't sue a company in Cyprus or St. Vincent and the Grenadines, which is where many of these firms are incorporated, and even if you could, the legal costs would exceed any payout you're owed. The business model becomes even clearer when you understand the numbers. Let's say a prop firm has 10,000 active challenge takers per month, each paying an average of $400. That's $4 million per month in revenue just from challenge fees. Now let's say 5% pass, that's 500 funded traders, and of those 500, maybe 10% consistently make money and request payouts. That's 50 traders, and if those 50 traders average $2,000 per month in payouts, that's $100,000 per month in total payouts. So the firm is making $4 million per month in challenge fees and paying out $100,000 per month. That's a 97.5% profit margin. And this doesn't even account for the traders who pass but then fail on their funded accounts without ever getting a payout, or the traders who pass make a little money but never request a withdrawal because they're trying to grow their account, or the traders who pay for multiple challenges after failing, which is extremely common. The average person who tries prop trading doesn't just pay for $100 once, they pay for $100 5 or 10 or 20 times, keeps failing, keeps thinking that next time they'll pass, and the firm keeps collecting for $100 each time. And the marketing is brilliant and insidious. Prop firms sponsor YouTube traders and TikTok influencers who post their funded account balances and their payout screenshots and make it seem like anyone can do this, like prop trading is the secret that professional traders don't want you to know. And these influencers get affiliate commissions, typically 10 to 30% of the challenge fee, so they're making money every time someone signs up using their link, whether that person passes or fails, and this creates a massive conflict of interest. The influencer is incentivized to make prop trading seem easy and accessible and profitable, because the more people who sign up through their link, the more money they make, and they're not going to talk about the 95% failure rate or the difficulty of withdrawing profits or the fact that most funded accounts are just simulations, because that would hurt their conversion rate, would make fewer people click their affiliate link. The psychological aspects of prop trading are also important to understand because the whole system is designed to exploit cognitive biases and addictive tendencies. First, there's the sunk cost fallacy. You pay $400 for a challenge, you trade for a week, you're doing well, you're up 7% and need 8% to pass phase 1, and then you have one bad trade and hit your max drawdown and fail, and now you've lost $400 and all that time and effort, and the rational response would be to say, okay, this is too hard, I'm not going to try again, but instead most people think I was so close, I just made one mistake, if I try again I'll pass for sure, so they pay another $400 and try again, and this cycle repeats, people failing multiple times, keep paying, keeps thinking they're just one attempt away from passing, and the prop firms know this. They've designed the challenges to be just difficult enough that many people will get close to passing but ultimately fail, because getting close creates the illusion that success is within reach, which makes people more likely to try again. There's also the gamification and the social comparison. Prop firms have leaderboards showing top traders. They post success stories on social media. They create a sense of competition and FOMO. You see other people passing and making money, and you think, if they can do it, why can't I? And you don't think about the thousands of people who failed and aren't posting about it. You only see the winners. And this survivorship bias makes you overestimate your chances of success, similar to how casinos show you the slot machines that are paying out but don't show you the thousands of machines that are taking people's money. And just like gambling, prop firm challenges are psychologically designed to keep you coming back. The quick feedback loop, the near misses, the variable rewards, all of these create addictive patterns that keep traders paying for another challenge and another and another. Now, to be fair, not all prop firms are predatory and not all traders fail. There are legitimate prop firms that actually fund traders with real capital, that place real trades in real markets, that have reasonable pass rates and fair payout policies. Firms like TopStep Trader for Futures, which has been around since 2012 and has a track record of actually paying out millions to successful traders, or firms like FTMO, which is one of the larger and more established Forex prop firms and has reasonable transparency about their pass rates and payout procedures. But even with these more legitimate firms, the pass rates are still low, still in the 10 to 15% range, and you still need to be a genuinely skilled trader to succeed. The difference is that these firms aren't actively trying to scam you. They're running a legitimate business model where they fund skilled traders and share in the profits. But you need to understand that being a skilled trader is rare. Most people are not. Profitable traders, even with perfect execution and discipline, and prop firms, even legitimate ones, can only fund a small percentage of challenge takers because funding everyone would be financially impossible. The real truth about who makes money in prop firm trading is pretty simple. The firms make money, the affiliates and influencers promoting them make money, and a very small percentage of elite traders make money. Everyone else, the 95% who fail challenges, the people who pass but blow up their funded accounts, the people who make money but can't withdraw it, they're providing the revenue that makes the whole system work. They're subsidizing the payouts to the successful traders and the profits for the firms and the commissions for the affiliates. And while this isn't necessarily illegal or even unethical in all cases, it's important that people understand the reality before they start paying hundreds or thousands of dollars for challenges. Because the marketing makes it seem like prop trading is easy money, like it's a shortcut to professional trading. But the statistics tell a very different story. Let's talk about some specific examples of prop firms and their practices. Because not all firms are equally predatory, but almost all of them have practices that should raise red flags. There are firms that explicitly advertise no time limits on challenges, and then buried in the terms and conditions it says you need to trade for a minimum of 5 days, and if you make all your profit on day one, they'll disqualify you for not demonstrating consistency. There are firms that advertise unlimited challenges where if you fail you can immediately retry. Sounds great until you realize that each retry costs money and they're basically encouraging you to keep gambling. There are firms that allow you to trade news events during the challenge but not on the funded account, so you pass using a strategy you can't use when it actually matters. There are firms that advertise 90% profit splits but then deduct various fees from your payouts, platform fees, withdrawal fees, administrative fees, so your actual split is more like 70 to 75%. And there are firms that change their rules retroactively. You pass a challenge under one set of rules and then they send you an email saying they've updated their terms and conditions and now there are additional restrictions on your funded account that weren't there when you started. One particularly egregious practice is the scaling plan that many firms use. They tell you that you start with 80% profit split, but if you make 10% profit, you get scaled up to 90%. And if you make another 10%, you get scaled to a larger account size. Sounds good. But what this actually means is that you need to make 20% plus profit, which is extraordinary performance, just to reach the profit split and account size that should have been offered from the beginning. And during the scaling period, you're taking all the risk, you're trading with strict rules, and if you fail at any point you lose the account. Meanwhile, the firm has already collected your challenge fee and isn't at risk of losing anything. It's a brilliant way to extract more trading volume from funded traders while delaying or avoiding payouts. The regulatory situation around prop firms is murky and problematic. In the US, most of these firms are not regulated by the CFTC or SEC because they claim they're not offering investment services, they're offering educational or evaluation services. The challenge is educational. They say you're learning to trade under professional conditions, and the funded account is just a bonus for those who demonstrate skill. This regulatory arbitrage allows them to operate without the consumer protections that would apply to actual investment services. And many firms are incorporated in offshore jurisdictions with minimal regulations: Cyprus, St. Vincent and the Grenadines, Seychelles, places where it's easy to set up a company and hard for traders to pursue legal claims. And this should be a major red flag. If a firm isn't willing to incorporate in a regulated jurisdiction and submit to regulatory oversight, that tells you something about their business model and practices. There have been cases of prop firms simply disappearing with traders' money. Firms that collected hundreds of thousands or millions in challenge fees and then shut down, stopped responding to emails, took their websites offline, and vanished. And because there's no regulation and no insurance, traders have no recourse, the money is just gone. And while this is relatively rare with larger established firms, it's a real risk with newer firms or firms that are struggling financially. If a prop firm is having a bad month, if too many traders are profitable and requesting payouts, there's nothing stopping them from just closing up shop and keeping whatever money they have, starting over under a new name in a new jurisdiction. The comparison to gambling is deliberate and important because prop firm challenges operate on very similar psychological and economic principles to online gambling. Both involve paying money upfront for a chance at a larger payout. Both have low success rates that are mathematically stacked against the participant. Both use psychological techniques to encourage repeat participation even after losses. Both show you winners while hiding the much larger number of losers, and both are largely unregulated and operate in legal gray areas. The main difference is that gambling is recognized as gambling and is regulated accordingly in most jurisdictions, while prop firm challenges are marketed as professional trading opportunities and escape gambling regulations by calling themselves educational services, but functionally, for the vast majority of participants, paying $400 for a prop firm challenge is just a bet, a gamble that you can hit certain profit targets within strict rules, and the odds of winning that bet are not good. Now, some traders will object to this characterization, will say that trading is skill-based while gambling is luck-based, and there's some truth to that. Trading does involve skill, analysis, decision-making, but the prop firm challenge structure is designed to introduce so much luck and randomness that skill becomes almost secondary. You can be a profitable trader over the long term but still fail prop firm challenges because you had a couple of bad trades that hit your daily loss limit, or because market volatility spiked during your challenge period, or because you made a small rule violation you didn't know about. The challenges are short-term, high-pressure environments where luck plays a huge role, and this is by design. If the challenges were longer and more forgiving, more people would pass, and that would break the business model. The mental health impact of prop firm trading deserves discussion because it's significant and underreported. There are traders who have spent thousands of dollars and hundreds of hours attempting prop firm challenges, failing repeatedly, getting close but never quite passing, and this takes a psychological toll: feelings of inadequacy, depression, financial stress from wasting money on challenges, relationship problems from spending so much time and money on something that isn't working, and for young traders, particularly teenagers and people in their early 20s who are targeted by prop firm marketing, this can derail their lives. They drop out of school or quit jobs to focus on trading. They go into debt paying for challenges. They isolate themselves socially to spend more time practicing. And when it doesn't work out, when they finally accept that they're not going to pass, or that even if they pass, they're not going to make consistent money, they're left with nothing. No education, no work experience, no savings, just a lot of trading knowledge that doesn't transfer to any other career, and a lot of psychological damage from repeated failure. There's also a demographic aspect worth noting. Prop firms disproportionately market to young men in developing countries where $47,000 for a month of trading would be life-changing money. You see ads targeting traders in Nigeria, India, Philippines, Countries where the average monthly income might be $200 to $500 and the promise of making $5,000 or $10,000 per month trading is incredibly appealing. And for these traders, even the $400 challenge fee represents a significant investment. Might be a week or two of wages, but they see the success stories and think this is their ticket to a better life. And the prop firms know this. They specifically target these markets because the psychological appeal is so strong and because people are willing to keep trying even after multiple failures. The opportunity cost of their time is lower and the potential rewards are higher relative to their local economy, so they'll pay for 5, 10, 20 challenges hoping to pass, and the prop firms collect their money while providing almost nothing of value in return. So what's the solution? Should prop firms be banned? Should they be regulated? Should traders just avoid them entirely? The answer is nuanced, legitimate prop trading, where firms actually fund skilled traders with real capital and share in the profits, is a fine business model. It gives talented traders without capital a way to trade professionally. And it gives firms access to diverse trading strategies and perspectives. The problem is that most of what's marketed as prop trading to retail traders isn't this. It's a challenge fee business dressed up as a funding opportunity, and the lack of regulation allows predatory practices to flourish. What's needed is transparency and regulation. Prop firms should be required to disclose their pass rates, their payout rates, their actual business model. Are they placing trades in real markets, or is it a simulator? If they're taking the other side of trades, they should say so. If they're charging fees that reduce profit splits, they should be upfront about it. And there should be regulatory oversight to prevent the most predatory practices, retroactive rule changes, arbitrary disqualifications, unannounced fees. For traders, the advice is pretty straightforward. Approach prop firms with extreme skepticism. If you're going to try prop trading, understand that you're probably going to lose your challenge fee. Treat it as tuition, as payment for the experience of trading under pressure, not as an investment that's likely to return profit. Only risk money you can afford to lose completely. Don't pay for challenges with rent money or savings you need, and definitely don't quit your job or drop out of school to focus on prop trading unless you're already a consistently profitable trader with a track record. If you're new to trading, don't start with prop firms. Start by learning to trade profitably with a small live account, $500 or $1,000 of your own money, and only consider prop firms once you've proven to yourself that you can actually make money trading. Because if you can't be profitable with your own small account, you're not going to suddenly become profitable in a prop firm challenge with stricter rules and more pressure. And be very careful about which firms you choose. Do research, read reviews. Look for firms that have been around for several years and have a track record of paying out. Avoid firms that are incorporated in sketchy offshore jurisdictions with no regulatory oversight. Avoid firms that make unrealistic promises. If a firm claims you can make $10,000 per month after passing a $300 challenge, that's marketing bullshit. It's technically possible, but so statistically unlikely that it shouldn't be. The expectation: look for firms that are honest about their pass rates, about how difficult the challenges are, about what percentage of funded traders actually make money and get payouts. If a firm won't disclose this information, that should tell you something. The broader lesson from the prop firm trading phenomenon is about financial literacy and critical thinking. The rise of prop firms is part of a larger trend of financial services marketed to people who don't fully understand what they're buying, similar to how Forex brokers market currency trading to retail traders who have no business trading currencies, or how crypto exchanges marketed leverage trading to people who barely understood what Bitcoin was. There's an industry of companies making money by selling financial dreams to people who are desperate for economic opportunity, and these companies use sophisticated marketing, social proof, influencer partnerships, and psychological manipulation to convince people to give them money for services and products that are unlikely to benefit them. And in an ideal world, people would be educated enough to see through this marketing, to understand the odds, to make rational decisions, but in reality, most people aren't financially literate, don't understand trading or statistics or business models, and are vulnerable to promises of easy money. especially when those promises are delivered by charismatic YouTubers with luxury cars and trading setups. The truth about prop firm trading is that it's primarily a marketing and challenge fee business that makes most of its money from failed traders, not from trading profits or from successful trader payouts. The challenge structure is designed to have a high failure rate because that's what makes the business model work. The firms that pass are often trading on simulators, not real markets. So your success or failure doesn't affect the firm's bottom line. They make money either way. The withdrawal process is often difficult because firms are incentivized to delay or deny payouts when possible. The marketing is deliberately misleading, showing you success stories while hiding the 95% failure rate. And the entire industry exists in a regulatory gray area that allows predatory practices to flourish without consequences. For the small percentage of elite traders who can consistently pass challenges and make money, prop firms can be a legitimate path to trading with larger capital than they could access on their own. But for the vast majority, for the 95% who fail challenges or who pass but can't maintain profitability or who can't get their money out, prop firms are just an expensive lesson in financial literacy and probability, a $400 or $1,000 or $5,000 lesson in why things that seem too good to be true usually are, and why making money in financial markets is genuinely difficult regardless of how much capital you have access to. So if you're considering prop firm trading, go in with your eyes open, understand that you're probably going to fail, understand that even if you pass you might not make money, understand that even if you make money you might not be able to withdraw it easily, understand that the odds are mathematically stacked against you, and understand that the success stories you see on social media represent a tiny fraction of participants and are being used to market a product that doesn't work for most people. If you still want to try after understanding all of that, then fine, it's your money and your choice, but don't believe the hype. Don't think this is your ticket to financial freedom. Don't quit your job or invest money you need. Treat it as what it is, a very expensive, very difficult challenge that you're probably going to fail. And if you do happen to be part of the 5% that passes and the 1% that makes consistent money, congratulations, you're genuinely skilled and lucky. But recognize that your success story will be used to market this product to thousands of other people who won't be as skilled or lucky, and that your $47,000 payout is funded by the $400 challenge fees from hundreds of people who failed, and that the system only works because most people lose. And maybe ask yourself whether you're comfortable being part of that system, whether the money is worth knowing that it came from other traders' losses, because that's the truth about prop firm trading. It's a zero-sum game where the firm always wins, some traders sometimes win, and most traders always lose, and the game is rigged from the start to ensure this distribution of outcomes, and the house, as always, wins in the end.